You just lost money and you don't even know it yet. Your portfolio looks diversified. Different sectors, different stocks, maybe a bond fund or two. But underneath, you're making the same mistakes that destroy returns when markets actually matter. Let me show you what's broken. Picture this. It's 2008. Your portfolio has tech stocks, financial stocks, energy stocks, all spread out like you read in the textbook. Diversified, right? Then everything crashes together. Tech down 40%, financials down 60%, energy collapsing. You watch your entire portfolio bleed because you thought different labels meant different risk. They didn't. You own the same thing 7 different ways. That's mistake number 1, fake diversification. Most beginners buy what feels different but moves identical. They'll own Apple, Microsoft, Amazon, Google, and Tesla, then pat themselves on the back for spreading risk. But when growth stocks sell off, all 5 tank together. Same day, same percentage, same pain. Here's what actually happened in early 2022. The NASDAQ dropped 13% in 1 month. If you own those 5 diversified tech names, you didn't lose 13%. You lost 13% 5 times over. Your portfolio was just the same bet wearing different hats. Real diversification means owning things that move differently. Not just different companies in the same sector, different asset classes, different geographies, different risk profiles. When one falls, another should hold steady or even rise. That's protection. Everything else is theater. Now let's talk about mistake number 2, and this one's sneaky, over-diversification. Yeah, you can actually spread too thin. I've seen portfolios with 47 stocks. 47. The person thought more meant safer. But here's the math problem. If you own 47 stocks with equal weight, each one represents about 2% of your portfolio. Your best pick could double and you'd barely notice. Up 2%. Meanwhile, you're paying attention to 47 different earnings reports, 47 management teams, 47 sets of risks. You've built a full-time job that performs worse than an index fund. Studies show that after about 20 to 30 well-chosen stocks, additional diversification adds almost nothing. The benefit curve flattens. You're not reducing risk anymore. You're just diluting returns and creating noise. But here's the twist. 20 stocks in the S&P 500 isn't the same as 20 stocks across different asset types. If all 20 are large cap US equities, you're still concentrated. Geography matters, size matters, asset class matters. You could own 3 things and be better diversified than someone with 50. Which brings us to mistake number 3, ignoring correlation entirely. Most beginners don't even know what correlation means. It's simple. Correlation measures how 2 investments move together. A correlation of 1 means they move in lockstep. -1 means they move opposite. 0 means they're unrelated. If everything in your portfolio has a correlation above 0.8, you're not diversified. You're leveraged into one bet, and when that bet fails, there's no cushion, no offset, just synchronized destruction. Let me give you an example. Real estate investment trusts and utility stocks both seem safe. Steady dividends, stable businesses, but they often correlate heavily because they're both interest rate sensitive. When rates spike, both drop together. You thought you diversified from rates into utilities. Actually, you doubled down on the same risk. Bonds and stocks, though, historically they've had low or even negative correlation during crises. When stocks crash, investors flood into bonds. That's the offset you're looking for. That's actual protection. Here's mistake number 4, and it's costing you more than you think. Forgetting about rebalancing. You start with 60% stocks, 40% bonds. Nice and balanced. Then stocks rip higher for 3 years. Now you're 78% stocks, 22% bonds. You didn't change anything, but your risk profile completely shifted. You're way more exposed than you intended. Then the market corrects, and you lose more than you planned for because you never reset. Rebalancing forces you to sell high and buy low. When stocks run up, you trim them back to your target. When they crash, you buy more. It's automatic discipline. Without it, your portfolio drifts into whatever's been working lately, which is exactly what's about to stop working. Most people rebalance once a year. Some do it quarterly. The exact timing matters less than doing it at all. Set a calendar reminder. Stick to it. Your future self will thank you when the market turns and you're not overexposed. Now we hit mistake number 5, chasing past performance. Last year's winner becomes this year's purchase. Tech dominated for a decade, so beginners piled in at the top. Crypto ripped in 2021, so they bought at $60,000. Emerging markets crushed it in the mid-2000s, so money flooded in right before the 2008 collapse. Performance chasing feels smart. You're buying what's proven. But markets don't work that way. What worked best recently is often the most crowded, most expensive, most vulnerable trade. By the time you notice it, institutional money is already looking for the exit. Diversification isn't about owning last year's winners, it's about owning next year's survivors. That means holding things that aren't hot right now, boring stuff, unloved sectors, international markets that haven't ripped yet, value stocks when everyone wants growth. It feels wrong in the moment. Your friends brag about their tech gains while you're holding boring dividend stocks and international funds. But when the cycle turns, and it always turns, you're the one still standing. And that leads us into mistake number 6, something almost nobody talks about until it's too late. Ignoring tax efficiency. You built this beautiful, diversified portfolio, stocks, bonds, REITs, international funds. Then April comes and you owe thousands because you didn't think about where you held what. Taxes aren't just an annoyance. They're a drag on returns that compounds over decades, and most beginners hand over chunks of their gains simply because they didn't structure things correctly. Here's what matters. Tax-advantaged accounts like 401ks and IR as shelter your investments from annual taxes. Taxable brokerage accounts don't. So what goes where? Bonds and REITs throw off interest and dividends taxed at ordinary income rates, sometimes over 30%. Those belong in tax-advantaged accounts. Stocks, especially index funds you hold long-term, generate capital gains taxed at lower rates, often 15% or even 0 if your income's low enough. Those can live in taxable accounts without killing you. But people do it backwards constantly. They hold bonds in taxable accounts because bonds feel safe, then get slammed with tax bills. Meanwhile, they stuff growth stocks into IRAs where the tax advantage is wasted. Location matters as much as allocation. Another thing? Turnover. Actively managed funds trade constantly, generating taxable events every time they sell a winner. Index funds barely trade, so they're far more tax efficient. If you're in a taxable account, low turnover isn't just nice to have. It's essential. One last point on taxes. Tax loss harvesting. When an investment drops, you can sell it, realize the loss to offset gains elsewhere, then buy something similar to maintain your allocation. It's free money left on the table if you're not doing it. Some robo-advisors automate this. If you're managing manually, learn the wash sale rule and do it yourself. Now let's talk about mistake number 7, over-diversifying into confusion. Yes, that's a thing. There's a point where adding more holdings stops reducing risk and just makes your portfolio impossible to manage. I've seen portfolios with 47 funds. 12 of them were large cap US equity. Why? Because someone read that diversification equals safety, so they kept adding without understanding what they actually owned. After about 20 to 30 individual stocks, additional diversification barely moves the needle on risk reduction. The same applies to funds. Owning 8 S&P 500 index funds doesn't make you 8 times safer. It makes you own the S&P 500 8 times with 8 expense ratios. Complexity isn't sophistication, it's clutter. A well-diversified portfolio can be built with as few as 3 to 5 funds. US stocks, international stocks, bonds. Add a REIT fund or commodities if you want. Done. You don't need sector funds, thematic ETFs, and niche plays unless you have a very specific reason and truly understand the correlations. Simplicity has another advantage. You'll actually stick with it. When your portfolio has 40 holdings and the market dumps, you won't know what to do. You'll panic, second-guess every position, and probably sell the wrong things. With 5 funds, you know exactly what you own and why. Rebalancing takes 10 minutes. Decisions are clear. That brings us to mistake number 8, and this one's psychological. Emotional rebalancing. The market crashes 30%. Your diversified portfolio is down, but not as bad as the S&P. Bonds and international holdings cushion the blow. Now you're supposed to rebalance. Sell some bonds, buy more stocks while they're cheap. But it feels insane. Stocks just collapsed. Every headline screams recession. Your gut says, wait, don't buy now, it could go lower, so you freeze. You hold cash. You skip the rebalance. Then stocks rip 40% off the bottom and you missed it. Diversification only works if you have the discipline to rebalance when it's uncomfortable. And it's always uncomfortable. Selling what's been working to buy what's been losing goes against every instinct. That's why most people fail at it. The fix? Automate as much as possible. Set rules. If stocks drift more than 5% above target, rebalance. No emotions, no debate. You either follow the system or you don't have one. Some platforms let you auto-rebalance. Use them. Remove yourself from the decision entirely. Mistake number 9, forgetting about inflation. You diversified into bonds for safety. Conservative, right? Except inflation runs at 4% and your bonds yield 2.5%. You're losing purchasing power every single year. Diversification isn't just about volatility. It's about protecting real wealth, the stuff you can actually buy. Stocks historically outpace inflation. Real estate does too. Commodities often spike when inflation runs hot. Bonds? They get destroyed unless they're inflation protected like tips. A portfolio that's 80% bonds might feel stable, but if inflation quietly erodes your spending power for 20 years, you'll retire broke in real terms. You need growth assets, even if they're volatile, to stay ahead of rising costs. The right balance depends on your timeline. Young investors can handle more stocks because they have decades to recover from crashes and benefit from growth. Retirees need more bonds for stability, but still need some inflation hedge or their fixed income becomes worthless over time. Which brings us to the final mistake, and it's the one that ties everything together. Diversifying without a plan. You own a little of this, some of that, maybe a bit of crypto because your cousin mentioned it. But why? What's your goal? What's your timeline? What level of risk can you actually stomach when things go wrong? Diversification isn't a random collection of assets. It's a deliberate structure built around your specific needs. If you're 25, your diversification looks nothing like someone who's 55. If you're saving for a house in 3 years, it's different than saving for retirement in 30. Without a plan, diversification is just noise. You'll own things that contradict each other, take risks you can't afford, or play it so safe you never build wealth. Start with the goal, then build the portfolio, not the other way around. Diversification isn't about collecting assets like baseball cards. It's about building a system that survives what you can't predict. Fix these mistakes now, before the market tests you, because when things break, and they will, you won't get a second chance to reposition. Your portfolio either works when it matters or it doesn't.